Hi, I'm Philip Chandler. I head our UK multi-asset team here at Schroders and manage the Foresters Stakeholder Fund. Today, I'd like to update you on what's happened in markets in the first half of this year and what we think is coming up for the second half of 2024. Stock markets had a great start to the year, with global equities gaining 12.5% in the first 6 months of 2024. That's in sterling terms, so in other words, what you would receive as a UK investor buying global equities. I think there's two main stories behind this strong performance. The first story is AI, or artificial intelligence. Many investors are predicting that AI will be transformative in a variety of industries. And it seems a great opportunity for the big tech stocks like Microsoft, Meta, that's the parent company of Facebook, Amazon and Google, who are spending billions of dollars investing in AI. But it's an even bigger opportunity for the likes of Nvidia, who makes so many of the chips that are used for AI. Nvidia's profits have dramatically increased over the past year, and its share price increased by nearly 150% in the first half of this year alone. Other semiconductor manufacturers are also doing well. The second story is that growth has been okay when inflation has fallen. Investors keep using airplane analogies for the economy. Will we have a soft landing, a hard landing, or no landing? And clearly the desire is for a soft landing, a gradual economic slowdown. To fight inflation, central banks like the Bank of England, US Federal Reserve and European Central Bank increased interest rates to slow the economy and thus bring inflation down. In a soft landing, growth and inflation gently come back to target. But in a hard landing, that was where you'd see central bankers slowing the economy too much and causing a recession. Whereas in a no landing, they haven't done enough to get inflation back under control and may have to raise interest rates even higher. Earlier this year, there were worries about rising inflation, which caused concerns about the economy. However, more recently, there's been a shift towards slower growth and inflation, which has been seen as positive. This slower growth is good for stocks because it allows companies to maintain reasonable growth and profitability, while lower inflation gives central banks the flexibility to lower interest rates. And indeed, interest rates have already fallen in the Eurozone, Sweden, Switzerland and Canada, and investors are hoping that the Bank of England and US Federal Reserve will soon follow. This move to a gradual slowdown has been good for most major equity markets, with stocks in the UK, Europe, Japan and emerging markets all up around 7 or 8% in sterling terms. But US stocks really benefited from the AI theme as well, and that boosted their returns to over 15% for UK investors. While the reconfirmation of a smooth economic transition has been good news for equities, it's been a disappointment for many bond investors who expected a more challenging economic situation or recession earlier this year. It may sound strange, but government bond investors like recessions, as central banks tend to lower interest rates, making fixed-rate bonds comparatively more appealing to investors. As the risks of a severe economic downturn diminished, bond returns remained relatively unchanged in the first half of the year. When we consider everything, multi-asset portfolios that hold both equities and bonds delivered pretty reasonable returns in the first half of the year, nicely ahead of the returns you'd see on cash held in a regular savings account. And in our portfolios, we've been overweight equities. In other words, we've had a higher allocation to equities, so that's contributed even more to returns. So what about the second half of the year? Well, with the outlook suggesting a gradual economic slowdown, it bodes well for returns. Economic activity remains positive. Inflation is moderating. We should see other central banks cutting interest rates, and the important one to watch there is the US Federal Reserve. If growth is okay and the Fed are lowering interest rates, then it should be good for both equities and bonds. This doesn't mean that it will all be plain sailing though. I think there are two things in particular for us to be wary about. The first is the increasing concentration that we've seen in equity markets. And here, concentration refers to the degree to which investments are dominated by a small number of companies or a particular industry. I mentioned how well those big US tech stocks like Nvidia have done, but the rest of the market hasn't fared as well. I don't think we're in a bubble yet. This isn't like the late 1990s tech boom, as this time the main winners are all highly profitable and cash generative. And that's very different to when the tech bubble burst just over 20 years ago. Nonetheless, there's a risk in that concentration and something for us to watch out for. In other words, the AI story, which has been so positive for returns recently, risks being a double-edged sword. The second main risk is politics. The UK election wasn't a worry for markets, as opinion polls showed Labour with a clear and consistent lead. But across the channel, investors are still watching France to see what will happen after their indecisive parliamentary elections. And then the big event this year is the US election in November, where uncertainty is high and the two parties' platforms differ on tax, spending, immigration, and the environment, to name but a few important differences. What's really significant is that the US budget deficit is remarkably high. The latest projections have the US government spending $1.9 trillion more than it will raise in taxes this year. And that's a phenomenal sum of money and means that the US government has to borrow to fund the deficit. Critically, neither Democrats nor Republicans seem inclined to address the problem, and that could cause significant worries in bond markets if there's a crisis of confidence, so that's something to watch out for. As always, it's important to remember that investing carries some level of risk. Our goal is to capture returns in markets for you whilst watching out for storm clouds on the horizon. If we're worried about something, then we can try to avoid it by reducing that risk in portfolios. Or we can try to mitigate it by finding hedges, so trades that will benefit from the risk and offset the adverse performance. Today, we have a higher equity weight in portfolios to capture the theme of OK economic growth and moderating inflation, but we remain vigilant against the risks I just described. However, please bear in mind that investments can fall and you may get back less than you invested. We're here to help you navigate the investment market. Thanks for watching.